Now, weak metal prices have weighed on Northam Platinum, with the miners' profits slumping 93% in the interim period. Joining me now to dig deeper into the numbers is company CEO Paul Dunne. Paul, thank you so much for joining us today. Now, it's been a tough time for many PGM miners, and Northam isn't any different. Right at the top, just contextualize the 6 months that was and the factors that weighed on profit.
I think it's also worth beginning with the fact that we had a very strong operational performance. So it's record production and record sales, but despite that, was not enough to combat a very severe fall in the prices of our products, in particular for rhodium and palladium across this period. It's quite severe, and that's what's caused a poorer or a worse financial performance.
Now, going through your financial statements and outlook on prices, I might say that the forecast is quite grim. How does the business plan on positioning itself to withstand the downturn in prices?
Yeah, as a mining company, the only defense we have against poor prices, which is common for everybody, is our operational cost performance. So can we position the company to produce at the lower end of the cost curve? We have three mining operations. Booysendal is doing very, very well. There's no question that Booysendal is in the low part of the cost curve. Our Zondereinde mine, which is between Northam and Zondereinde, and Thabazimbi, excuse me, is a deep level conventional mine that's sitting in the middle of the cost curve. And our new, very, very young Elam mine is on the high end of the cost curve, but still in development. So our competitive response and our response to combat the market is to make sure that we produce at the best possible cost.
So, Paul, I must admit, I haven't been around long enough to witness any of the other downward price cycles. And I just would like to know if there's anything more concerning about this particular cycle.
Yeah, I think we are concerned. You know, I mean, you haven't been around to see maybe too many of these cycles, but as you can see, I have, and I started in the business in the in '87. Yeah, so I've seen quite a few down cycles. This is a pretty harsh one so far, but it's early days. Let's see how it develops. But in terms of its severity in the immediate, it's harsh.
Now, I want us to talk about Royal Bafokeng and how at the beginning, when you did initially buy that stake in Royal Bafokeng, you initially saw value and you acquired it at the top of the cycle, right? Could you have not have held on for longer? Perhaps take those short-term gains, pains for longer-term gains?
Yeah, I mean, also worth pointing out on that point is that was 2.5 years ago now.
Yes.
When we first took that position. It was a risk mitigated position in that we bought just less than 35% of the Royal Bafokeng equity. This is an extremely important point. Below 35%, we had a voluntary offer in place. When you have a voluntary offer, you are able to protect yourself against the market using material adverse condition clauses, of which there were 4 in our case, against a potential market downturn. Of course, the market did turn against the transaction. All 4 of those material adverse conditions were breached and continue to be breached today. And therefore, we could not pursue the transaction at the same value. We still believe those assets are a good set of mining assets, by the way. And Impala in the long term will do very well with those assets. But in the short term, we can't pay the same value. And unfortunately, the market has not supported the transaction. Once you move above 35%, it's mandatory. If you move into a mandatory offer, you forgo your ability to introduce market protection conditions.
I wanted to get back to some of the operational things that we've been talking about. You've also paused some of your capital projects, of course, to keep more cash on hand in this tough environment. Paul, how does this move impact your production targets moving forward?
So in the short term, it doesn't impact the project timelines too much. So short term meaning 6 months. So if we were to hold an activity for 6 months before we get going again, then it becomes really a cost escalation issue rather than a production issue. If you hold activity beyond 6 months, in our context, it does start to hurt.
And now Northam is one of the few PGM miners that isn't cutting jobs. Would you say this is just a reflection of a stable balance sheet and ability to somewhat contain costs?
Yeah, we are to a very high degree, we have a fixed cost element to the cost structure. It, in some cases it can be as high as 80%, but let's use the 70% marker as a good reference point. If you have 70% fixed cost, 30% variable, in a falling production environment in particular, it's very adverse towards unit cost performance and therefore your competitive position. If you can grow production against your fixed cost, on the other hand, it's beneficial. However, I do want to point out that these movements are at the margin. The severity of this market condition outweighs those considerations because the market condition, as we are speaking today, even an improvement in the unit cost performance of 1 or 2% will not correct profitability. So it is quite serious. And in our opinion, and it's a big if this market condition persists, we will see structural change across the PGM miners across the world.
Paul, thank you so much for your time and insights. We'll definitely catch up with you again in the next 6 months. That was Northam Platinum CEO Paul Dunne.